Hello students, the next concept that we are going to study under the first chapter is clubbing of income. Under the Income Tax Act of 1961, an assessee is generally taxed in respect of his own income. However, there are certain cases where an assessee has to pay tax in respect of income of another person, because sometimes assessee may transfer his asset or income to his closed ones who are in lower tax bracket to avoid tax payment. When clubbing of income is done, they cannot do so. That is, they cannot transfer their asset or income to another person to avoid tax payment. It restricts assessee from saving tax. Clubbing of income means the process of including income of one person with the total income of another individual. Clubbing of income means the process of including the income of one individual in the total income of another individual. That is clubbing of income of two individuals. The income so clubbed is called as deemed income. Section 60-64 of Income Tax Act of 1961 is relating to clubbing of income. Clubbing of income means combining the income of two persons. Let us see some of the situations where income of two persons are clubbed. First condition or first situation is transfer of income without transfer of assets. Section 60 defines this situation. If a person transfers to another person his income from an asset without transferring its ownership, such income shall be deemed to be income of the transferor. Without transferring the ownership, if he transfers any of his income to other person, that income is considered as the income of the transferor itself. It does not become the income of the transferee. So, this income is taxed in the hands of the transferor itself. That is the transfer of income without transferring the assets or ownership of the asset. Second one is revocable transfer of assets. Transferring assets on the condition that it can be revoked later. Here revocation means cancellation of that transfer. If the agreement of transfer, in that they mention this condition, that is revocation of the contract or revocation of the transfer, the income of such asset is considered as the income of transferor and taxable in the hands of transferor itself. Because after the tax payment they can revoke, that is cancel the agreement of transfer, and he may take back the ownership of the asset. That is why in case of revocable transfer of asset, the income from such asset is taxable in the hands of transferor himself. There are some exceptions for this revocable transfer of assets. They are, if the assets transfer is under a trust, if they are transferring the asset under a trust agreement, it is not revocable during the lifetime of the beneficiary. Second exception is, in the case of direct transfer to the transferee, it is not revocable during the lifetime of the beneficiary. Beneficiary means to whom the asset is transferred. In the case of transfer before 1st April 1961, if it is not revocable for a period of exceeding 6 years, they cannot revoke the transaction or a transfer of the asset. This is the second situation where the income is taxed in the hands of a transferor or clubbed with the income of an individual. Next, third one, remuneration of a spouse, section 64, subsection 1, clause 2. If the spouse of an individual receives any remuneration such as salary, commission, fees or any other form of income and by any mode, that is in the mode of cash or kind, from any concern in which individual have substantial interest, that kind of income of a spouse is taxable in the hands of the individual himself. Here substantial interest means he also having some right in that concern or in that income. Substantial interest means in case of a company, individual by himself or along with the relatives beneficially owns 20% of equity shares of that company. If he owns 20% of equity share or voting right of that company, he is called as having substantial interest in that company. In case of non-companies, individual by himself or along with his relatives share at least 20% of the profits of the concern. In case of non-companies or in any other field, they are earning profit or income, that individual must have 20% of profit from that work. Then only we can call him as a person having substantial interest in that field. So, if the spouse of that kind of person or individual is receiving income in these modes, that is salary, commission, fee or any other form of income, that income is taxable in the hands of individual, he is having substantial interest in that concern. There are some exceptions to this rule, that is such income can be taxable in the hands of a spouse himself or herself. That exception is if spouse possesses technical or professional qualifications and such income is solely attributable to the application of his or her technical or professional knowledge or experience. That means if the spouse possesses any technical or professional qualification, she or he is earning money on the basis of their own qualification, that income is taxed in their hand only. They cannot transfer that income to the individual for the purpose of tax liability or payment of tax liability. That is the exception to the rule. Remuneration of a spouse can be transferred to the individual for the purpose of payment tax, that is clubbing or combining of income of individual and his spouse. What is the exception? If the spouse possesses any technical or professional qualification and he or she earning money out of their own qualification, that money or income can be taxable in the hands of himself or herself. Next situation is income from assets transferred to spouse. Any direct or indirect transfer of assets to spouse by an individual for inadequate consideration, income from out of such assets shall be included in the total income of such individual. If the assessee or individual is transferring any asset to his spouse or her spouse for inadequate consideration. Consideration means something in return. Here there is no any adequate or proper return from the spouse for this transfer of assets. In that case, that income from assets is taxable in the hands of individual only. They have to club that income to pay tax. Here you have to remember inadequate consideration. If there is any inadequate consideration or there is no any proper return from the spouse, the income is clubbed for the purpose of tax payment. There are some exceptions to this rule, that is income from the assets transferred to the spouse can be taxable in the hands of that spouse only. That exceptions are: first one, where asset is received as a part of divorce settlement, because after divorce they are not living together. In that case, that transfer of asset, income from that transfer, the tax payment is done by the spouse himself or herself. Next, second exception is if assets are transferred before marriage. If the asset is transferred before marriage, that income is taxable in the hands of spouse himself. Next one, no husband and wife relationship subsists on the date of accrual of income. After divorce or after separation, if they earn any income out of that transfer, that income is not taxable in the hands of individual. They cannot club their income for the payment of tax. Next exception is asset is acquired by the spouse out of pin money. Here pin money means allowance given to the spouse for his or her personal and household expenses. If they are acquiring asset or transferring asset in return to this pin money, it is not clubbed. This income is not clubbed. They have to pay tax separately. So this is the fourth situation under clubbing of income. Next, fifth one is income of daughter-in-law, section 64 subsection 1 clause 6. Here any direct or indirect transfer of assets to daughter-in-law or minor grandchild by an individual for inadequate consideration. Income from out of such assets shall be included in the total income of such individual. Here also for inadequate consideration, there is no consideration or there is nothing in return. In that case, that kind of transfer is not acceptable. Here the individual who is transferring the asset is responsible for the payment of tax for such income. Here the authority is considering this transfer for inadequate consideration as avoidance of tax. That is why this transfer is not acceptable for the purpose of income tax payment. Next concept is transfer of assets to other persons or association of persons for the benefit of spouse or minor child under section 64 subsection 1 clause 7. If an individual is transferring any asset to other person or association of persons to give benefit of that transfer to his spouse or minor child, such transfer of asset cannot be acceptable for the purpose of income tax. That means the transferor himself has to pay tax for the income from that asset. There are some conditions under this kind of transfer. An individual transferring asset directly or indirectly. If he transfers the assets indirectly or directly to persons or association of persons, and the asset is transferred to a person or association of person. Next one is, it is transferred for the immediate or deferred benefit of his or her spouse. Here that kind of transfer may result in immediate benefit, or benefit can be received in later days, and the transfer is without adequate consideration. Here also, if there is no any adequate consideration, that kind of transfer is not acceptable, and the income out of that kind of transfer or that asset is taxable in the hands of individual only. So, this is the case where an individual transferring assets to other person or association of persons which can be beneficial to his spouse or minor child. If there is no adequate consideration for that kind of transfer, that income is taxable in the hands of the transferor, that is clubbing of such income with the income of the individual. Next case is income from transfer of assets to other persons or association of persons for the benefit of son's wife, that is for the benefit of daughter-in-law. Section 64 subsection 1 clause 8. This is same as a previous case, but here the beneficiary is daughter-in-law. Transferring any assets directly or indirectly for the inadequate consideration to any person or association of persons for the benefit of daughter-in-law, either immediately or on deferred basis. Here benefit may be immediate one or benefit received in later days. For inadequate consideration, he or she is transferring the asset to any other person or association of persons. That type of income is clubbed with the income of that individual who is transferring that asset. Next case is income of a minor child, section 64 subsection 1a. Income of a minor child will be clubbed with the income of parents whose income is higher. That means income will be clubbed in the hands of higher earning parent. If mother is earning more, this income of a minor is taxed in the hands of mother. If father is earning more, taxed in the hands of father, like that. If the marriage of the parents is does not subsist, that means if the parents are divorced, the income shall be clubbed in the income of the parent who maintains the minor child in the previous year. The parent who is looking after the child in the previous year, with the income of that parent, income of a minor child is clubbed if the parents are separated. There are some exceptions to this rule, that is income of a minor is not taxed in the hands of or with the income of parents. That exceptions are income from manual work. If a minor child is earning income on his own effort, that kind of income is not taxed in the hands of his or her parent. Or income from activity involving application of his specialized knowledge or experience, that is income is earned on his own talent. That kind of income is not taxed in the hands of parent. Next one, income of a minor child suffering from any disability of the nature specified under section 80D. If the income of a minor child suffering from any disability mentioned under section 80U, if they are earning that income, that is 75,000 in case of person with a disability and 1,25,000 in case of person with severe disability, that income is not taxed in the hands of parent, because here minor child is receiving this income for his disability. So, this kind of income is not taxed, or here parent cannot claim for deduction for this type of income. Next one is transfer of a separate individual property to Hindu undivided family of which he is a member. In case a member of Hindu undivided family transfers his own property or self-occupied property to HUF for inadequate consideration, that is for without any benefit in return, the income from such property shall be treated as income of the transferor himself. It cannot be taxed under the income of a Hindu undivided family. This income is clubbed with the income of the transferor himself. So, these are the various cases where the income is not treated separately. Here income is clubbed with the income of an individual taxpayer. This is known as clubbing of income. Let us stop this session here. In the next session, let us study about set off of losses. Thank you. Let us meet in the next session.